And this is our Tuesday real estate investing zoom.com live call. We do every Tuesday, 3 p.m. live Pacific time, and that's 6 p.m. on Eastern time. And we also stream it live on YouTube and Facebook, and then record it, put there as well. So this is really for first-time investors, wholesalers, bird doggers, real estate agents as well as experienced and vendors. And we try to get together and create a little bit of some education and a marketplace where we can share ideas, best practices, encourage each other, push each other to do more business and make more money. One of the ground rules I tell people all the time is, my first coach was Zig Ziglar. He said, you can have anything you want in life if you help enough other people get what they want. And one way to do that is by participating in a way that helps other people. So if you're on the call, you have a question, unmute yourself, ask a question, or put in the chat box. I do my best to try to catch all of them. If you're watching this live on YouTube or Facebook or LinkedIn, put them messages there as well, and we often are able to catch them live on our phone call as well. And we'll include them in, we'll put them on live and give you credit for that. So the more you participate, the more money you make. I'm just curious, who here is to either increase their income and or increase their wealth? Say aye or raise your hand. I think that's everybody. We check. No, not you, Shane.
Aye.
Not. Aye. Okay, Dave's aye. Okay, good. Okay, so you're in the right spot. We want to make more money and or increase our wealth. That's what we're here for. So look forward to that. So I'm really excited to have today a special guest who's actually so wonderful that she's making a repeat performance. Gina Koenen is with Probate Bank, and she's an expert in financing multifamily properties. I'll let her go into details, but Gina, welcome to our call.
Yeah, thank you for having me. I appreciate it.
So quick, just a little background on you personally. Where are you from originally, and who are you, and how'd you get here?
I grew up in Southern California, been here pretty much my whole life, moved around Temecula, Wildemar, Corona area. Came into
Now you're
lending.
bragging. Now you're bragging.
Why is that bragging?
Corona, Wildemar. No, I'm just teasing.
It's fun. I came into lending around 2003, and I was very, very fortunate to have a mentor, senior lender that really just kind of took me under his wing and said, look, it's not complicated. It's not rocket science. If you understand how to run the numbers, how to teach other people, then you'll be successful. And so I have found over the years that I'm one of the few commercial lenders that not only says why we can or cannot do a loan, but I like to educate on why we cannot if we cannot, or why a loan amount works or doesn't work. And I've kind of created a little bit of a niche where a lot of residential brokers will come to me because I do take a little bit extra time to teach. And that helps. It helps me gain more business. It helps me gain more of a following. My brokers make more money because instead of saying no when they don't have sources for commercial loans, they're able to say, okay, Gina, how do I do this? And that's been fun. I mean, like you said, Bill, the best way to move forward and grow in life is to teach people how to do what we know how to do, right?
Yep, exactly. That's why I like having you on the call, because you're willing to do that. You do a good job of it. I think it shows your pleasure. So let's just do a quick overview. I know you sent me a couple things, a couple flyers or promotion materials, including a rate sheet. And not this isn't about being a shameless promoter, but I think more about educating people about the different types of products and different types of loans. So tell us, the first thing you have is a kind of overview of all the type of loans that you guys offer. Tell us a little bit about the product offerings at Probate Bank.
Well, Provident Bank's been around over 65 years. We are one of the largest small banks in California, if that makes sense. And our forte all day long is apartments. We love them. They're almost foolproof. Everybody needs a place to live. And especially in this current market where people trying to purchase houses, I mean, it's almost impossible, if not, paying 30% more than we would have paid 3-4 years ago. So multifamily all day long, I understand that product extremely well. We also love office, self-storage, and industrial, and we are currently looking at single-family construction, multifamily, some commercial on a case-by-case basis. I mean, the flyers are, created to stand the test of 5 to 10 years, and sometimes office construction, especially in this market where brick and mortar is becoming a little softer as a product to lend on, just because a lot of employees are at home, a lot of companies are downsizing, and we've got this new hybrid of people possibly staying at home for long periods of time. So again, case by case on office type construction, but single family, multifamily, we love those as well.
So let's talk about more in particular the multifamily. And again, this is your rate sheet that we had. And so let's just start from the beginning for somebody who's maybe looking to buy their first multifamily, or they're an agent who's looking to sell one to a customer for the first time. Let's just kind of get the lay of the land here besides your contact info. Let's talk about, you have multifamily A loan and multifamily standalone programs. What are the key differences between these two boxes that we would start with?
Well, in this particular market, it's comical. We're leaving our A pricing on the rate sheet because there are markets where A pricing is typically better than standard pricing. Mm-hmm. But as you'll see, the numbers are exactly the same. So right now, today, A pricing is identical to standard. But in a healthy market where rates are kind of on an increase, the A pricing would be more for a property that's under 30 years old, in pristine condition. Pricing is really set first and foremost to the property itself, and then secondarily to the borrower. So we might raise for a poor condition or properties that need some cosmetic repair or are a little bit older. We also, and a lot of lenders do kind of the same thing. If it's all studio apartments or one bedrooms, the turnover is a lot more frequent than it would be in apartments that have a blend of 2-bedroom units. So you'll find often that lenders will raise rates slightly if it's all studios, or best pricing out there is assuming some sort of a blend. And then if there's credit problems, if a borrower has excessive mortgage rates, or they have bankruptcies or foreclosures, not only will there be an add to rate, oftentimes they may have to use a different type of lender. And sometimes there's some soft money lenders or hard money lenders if they're, depending on the severity of credit issues. But that gives you an idea. So rate sheet, what you're seeing out here in front of you today, A and standard are exactly the same. And this is our best foot forward.
Got it. So we have in the programs 1, 2, 3 different types: a 1-year ARM, a 3-year ARM, and a 5-year ARM. So these loan programs, the term of them, how long the loan goes for, they're all 30 years, but the 1, 3, or 5 correlate to what? How long the fixed rate is locked in for that period of time?
That's correct. And as you'll see on the standard, we also have a 7-year. So the multifamily A has the 1, 3, and 5, and then the standard has the 1, 3, 5, and 7. And as I said, the rates are all the same. The loan itself is a 30-year loan, and a 30-30 simply says it's a 30-year loan, and the payments are amortized over 30 years. So that's the 230 on that, the 30 and 30. And then the 1-year, 3-year, 5-year, and 7-year, it's very common in commercial products for the banks to set the rate based on a certain rate of return. Therefore, they always have, or most, I hate to say always because I don't know every lender out there, but most investment lenders have prepayment penalties, which if you're coming over from the residential side for the first time, you are programmed against prepayment penalties. Your brain just wants to say, nope, I don't want it. But on the commercial side, it's extremely common. Most lenders out there have a prepayment penalty of some sort. Ours is what's known as a traditional step-down type prepay. So if you look on the far right column, you'll see, let's say let's look at the 5-year at par, because probably 95% of the loans that I quote are a 5-year at par. That prepayment penalty is 54321. And all that states is if the borrower pays off the loan in the first year, they're going to have 5% of the principal balance as a prepayment penalty. Second year, 4%, third year, 3, 2, and 1. And after the 5th year, prepayment penalty is gone. At that point in time, borrowers can refinance, they can pay off the loan, so, do anything they want without the prepayment penalty. And then what I often tell borrowers too, if they don't want the 5-year prepay, my question always is why? Are you just against prepays, or are you absolutely planning on selling off the property in a year or two? In which case I would put them maybe in a 3-year fixed as opposed to a 5-year. Does that make sense?
Right. So all you're doing is you're protecting the interest rate for the time from the bank's point of view. And if you don't want to be locked in, just take a shorter term on the rate. Now the trade-off there though is, let's just back up a little bit. So for under the 5 year, you have a par rate at 3.3. You have a 1 point rate at 3.2, which means I would pay the bank 1% to get the loan, or I
Right.
can raise the rate a little bit to 3.3. I'll be stuck. I'll be paying that for 5 years, an extra zero point 0.1, but I'm going to save zero point 0.1 times rate for 5 years. I'm going to save zero point 0.5, and I'm going to pay one less point. So I'm sorry, I'm going to pay zero point 0.5 times 5, which is half point more, but I'm going to save 1 point fee to the bank. So seems to me like unless I sell the property pretty quick, makes sense to go the par rate versus the 1 point rate, right?
Absolutely.
When I go up, again, I'm adding another 0.1 a year for 5 years because of the prepayment penalty. You're locked into that. I'm going to save a half point at close, but I'm going to pay that annually over time. It's really one hand and the other hand, they're about the same, right?
Absolutely.
Okay. Now, what happens when the loan rate, let's say in the 5 year loan, at the end of year 5, I still want to keep the property year 6. Maybe I can't refinance yet for whatever reason. What's the rate become in year 6?
At that point in time, the very first day after the fixed period, the rate will shake out to whatever the 1 year CMT, which is the 1 year treasury, whatever that is plus the margin. So as you'll see in the par row, it says 2.95. So whatever the 1 year CMT plus the margin is on day 1 of year 6, that's where the rate will adjust to. And then once every 6 months, the rate can go up as high as 1% over each time. So let's assume that the 1 year CMT with the margin at the end of the 5th period is now at 6%. 6 months later, the highest it can go up to is 7% if that were to push it. Otherwise, once every 6 months, your rate will readjust to the 1 year CMT, within that grace of that 1% margin over. Your start rate is always your floor, so you'll never drop below the start rate. And then your ceiling at 1% increments every 6 months to a maximum of 6% over the start rate. So a lot of borrowers, depending on the market, I mean, if we're in a rising interest rate market at the end of 5 years, they'll go ahead and refinance and fix again for another 5 years. But as you'll see in the last couple, 3, 4, 5 years, I mean, the rates just, if anything, have gone down or stayed the same. So a lot of borrowers have been kind of sitting and watching the market, because if the margin and the index aren't pushing the rate up, they're almost benefiting just kind of staying where they were. It just depends, on where they are on that time period.
Well, plus if your rents are going up on average 3% a year over 5 years, your rents are up by compounded probably 18%. If the market's as healthy as everything else, all things equal. So you have 8% more income for the same mortgage payment theoretically from 5 years ago. So, and even if rates go up more, normally that means rents go up by even more than that. So all things equal, not all things are equal for sure, but all things equal, your payment's going to cover, your income's going to cover any changes in the payment.
Exactly. And now that the rent eviction moratorium is over, landlords, owners of property are able to start raising those rents. And that's a beautiful thing, because the last year or two, it's been kind of a weird market.
So I'm going to quote you that the eviction moratorium is over now, right?
Well,
whoa.
Don't quote me on anything.
Gina, Vice President of Probate Bank says eviction moratorium is over. Go on and raise your rents. She's like, no. You didn't last this long by getting quoted that way. No, I got that. Yeah, that's another topic we'll get to in just a second. Right? So make sure we cover all the loan programs. So one of the things is obviously, homeowners, first-time buyers are pushed so much to use other people's money to get in as low down payment as possible, which can make sense for home buyers, first-time buyers, especially scraping money together, no money down, 3.5% down, 5% down. In multifamily, here you're showing up to 75% loan to value, but the reality is you really can't borrow that much money, can you?
No, and that's for a lot of people trying to purchase properties, especially multifamily today, with the landlord's inability to raise the rent, with everything that's gone on with COVID in the last couple of years. Every property that I'm seeing today that borrowers are trying to purchase, the rents haven't been raised in 5 years, sometimes even 10 years. And what you'll see in one of the columns on the rate sheet is the DCR, which is your debt coverage ratio. Most lenders are very similar. We're all looking for right around a 1.2 debt coverage ratio. Sometimes we get an aggressive lender that will allow a 1.15 debt coverage ratio. And what this says is that the property's net operating income must be at least 20% higher than the new annual mortgage payments. Now, if you can visualize with me that rents haven't been raised in 5 or 10 years, you can see that that net operating income is lower than what it would be if rents were at market. And they're selling these properties at, market cap rates, assuming all rents are at market, the value is there. But from an investment lending standpoint, we are only looking at what's actually in place. And most lenders won't take market because they say, well, if market rent is true, then why aren't you collecting market?
Good point.
So most of us are looking at in place. And, before you get to the appraisal, you can't know exactly what the net operating income is going to be at market, but there is a way to calculate that. And it really just comes down to looking at the historicals on the property. I like to use a rule of thumb of 35% of gross rents to calculate an idea of expenses. That'll give you at least a rule of thumb. And then most lenders will use a 5% vacancy factor, just kind of a what if, what if 1 or 2 of the units go away? That's how we get into our net operating income. And then you're just looking at the ratio between that versus the new annual mortgage payments. And like you said, Bill, 75% loan to value is the highest we'll go up to. But if rents are below market, we're really I just looked at one this morning and it's purchased, and the max loan to value I could get to once I hit my 1.2 debt cover was 68%.
68.
The borrowers want to put 25% down, but the rents in place just don't support it.
And so I think that's been fairly common now for a little while, which is if you're going to buy multifamily in Southern California, you're going to have to put down probably 30%, maybe 35% down to buy the property. And that's not just you guys, that's the industry with the debt service coverage. Yeah, and these properties are meant to be underwritten on the investment, not on the person, so that it makes sense that the investment has to cover everything by a nice margin. Tell me a little bit about, a first-time buyer. I have a friend of mine who started buying rental properties, and he was sharing with me that he doesn't use a property management company because the margins are so tight. And to his credit, he's taking the money he would pay the property management and putting that into a capital reserve fund for inevitable expenses. So that's great. So you're just hiring yourself as a property manager in essence, and you're at least realizing that you can't just spend that money. You got to do something with it. Tell me about a first-time home buyer. Do they need to use a property management company? Does that help in the underwriting? What kind of financial documentation reports do you see that they provide? Do they need help? How do you describe that process for a first-time buyer?
Well, like you're saying, that's super smart of the investor that you're aware of that's putting that money aside. And I do see that often. Every lender is different out there. Some lenders will require it, a property management for a first-time investor. It really comes to a case-by-case basis. It comes down to credit of the borrowers, how close do they live to the property, how many units. A lot of investment lenders out there just kind of slap on, look, 12 units or more, you have to have a property management company. It really comes down to case by case. But if we're talking about, 5 to 10 units and the borrower can show that they've been paying their bills, that they're fairly responsible, case by case, we may or may not require it. And I always encourage everybody to talk to the lender because all lenders are different on that. And I don't want to speak for every lender out there. The benefit to that is oftentimes, there's 5% property management fee that some investment lenders just slap on no matter what. We'll give 3% of that back as a self-management credit, which, as we talked about the net operating income, the debt coverage ratio, that helps increase the net operating income and helps them get a little bit more in loan dollars. So
it sounds good. I know, but I'm on the end of being a lender and a former lender and as a broker. It sounds good they do it on their own, but the reality is now you're doing it on your own. It's not a free lunch. That's tough work.
It's a lot of work. I mean, even just running your own house, let alone an apartment, toilets break, water heaters break. I mean, come on.
Exactly. We have a great property management company represented on the phone, Melissa Yolo, who's on with us regularly. So say hi, Melissa. She's got the mask on. She's in the office.
Yeah, I'm in office. We've been in office since the pandemic, and we do specialize in Los Angeles, residential for single family homes and multifamily complexes.
Great.
Hello.
Hello.
So what do you, how is the, you mentioned in passing, of course, it just, I think, has started, but it hasn't really impacted us yet, about the end of the moratorium on evictions. How is that, what do you see at your bank? How is that changing or going to change the landscape? Are you still kind of watching the news and watching the effect, or you seeing any preliminary changes in the marketplace at all?
Well, I'm certainly not an expert on that, but from my experience, from what I anticipate, this is just my opinion, so don't quote me, Bill.
Okay.
But I mean, for
Hold on,
landlords,
Gina, VP of Private Bank says, go ahead.
right. Um, there have been a lot of our landlords, a lot of people trying to purchase properties where you've got tenants that just haven't had to pay, they haven't been able to be evicted. Obviously, that causes a problem because when we take on a property, we're not only looking at leases in place, but we're looking at the tenants that haven't paid rent. And it was just a couple of weeks ago that we had 2 of 5 units, where you're needing every dollar to get to the loan amount that the borrower is seeking. And 2 of those units, they haven't paid rent since last October. So now we've got to look at the borrower's income to say, well, how are you going to afford to pay this mortgage until you can start getting that rental income?
Right.
With the ability for these landlords to start evicting, the question is, how soon are they going to be able to get them out? You say that someone's now due to be evicted, but they're still going to drag their feet. There's still delays, but eventually I feel like within a couple months, as long as everything rolls smoothly, those units that haven't been paying, those tenants that are now needing to go find other housing, those units will be replaced at market rent, which should, help the cap rates, help a lot of the numbers on these properties, help people buying properties so that, things are closer to market. That's the goal, of course. We'll see how that shakes out.
The challenge, one of the challenges is, of course, that the landlords are going to have the obligation of removing those tenants, those non-paying tenants.
Exactly.
And that is not a simple endeavor for sure, as we all know. But it is part of the pleasure of being a landlord.
That's a great point, Dave. Not counting the tenant improvements that are going to be needed in those units once
it's a time thing and it's a money thing. Just getting the tenant to vacate the property,
right.
And then, like you said, you're right. I mean, the improvements. If you haven't been paying rent and you are on your way out, some people take that as a license to damage someone else's property for, maybe penalize them. And it's unfortunate because a lot of people that have been affected by the pandemic, it's through no fault of their own. Their household income has changed significantly, and it's a real conundrum for sure.
Yeah, absolutely. Good points.
Yeah, it's a lot of my business are people who weren't really paying attention. They rented out a room. I had one of those on Sunday where they broke off 2 bedrooms and a bathroom and they rented that out. Well, good luck. You can't just tell them to leave. You can talk to them and negotiate. Not so simple as it used to be. And I think in addition to the legal changes, I seem to find there's almost an emotional or attitudinal change in the tenants versus 3-4 years ago, where they didn't want to be in eviction. They didn't want to go through the process. Now it just seems like that's just the rite of passage, and they're entitled to it as sure as they are other payments and such. So it's really challenging.
Yeah, absolutely.
So tell me though, overall, your business, I know as a bank, you guys have done really well. The market's been great despite a global pandemic, despite moratorium on evictions, despite people being displaced. What do you see in the next 6 months, 9 months, or a year? If you did that well with all this going on, what's next year look like?
I feel the market should continue to grow healthy. Again, on apartments alone, people always need housing. It's been a strong industry. I've been with Provident Bank since 2008, and that has always been, even to myself as a loan officer, that's always been my strongest product. I feel that after the last downturn around 2010, 2011, the regulators kind of came in and said, okay, the old school underwriting of just looking at the property alone and not looking at the borrower to make sure the borrower can feed themselves, pay their bills along with, the property carrying itself. That whole underwriting animal changed after that last downturn. And I feel that a lot of the lenders that are really taking a look not only at the property itself, but looking at the borrowers secondarily, making sure they've got, good credit, pay their bills, things like that. I think that's helped quite a bit in this particular market. I mean, obviously, there's no way even a lot of the strongest investors can carry a 12-unit property where 10 of the units aren't paying rent for, so that's obviously a downfall. But now with things kind of changing and the world somewhat finding a way to some kind of a normal in the next year or two, I just feel like everywhere we should see some healthy changes, some healthy momentum forward. Does that make sense?
Yeah, and I think what you're saying is, unfortunately, the people who were strongest were able to borrow and take advantage of this, and the people who were maybe average, couldn't make up for the lost rents potentially, kind of got passed by a little bit. So it's been on one hand a challenging market for, I think, the average consumer. The ones who experienced a lot of money did really well, and so perhaps opening up things will give the more average consumer a chance to compete in a level playing field. Let's hope.
I think so. Yeah, absolutely. Especially if the owners of some of these properties that want to get out of them, if they're able to get those units rented at market, it absolutely creates a world where maybe we can get back to 25 and 30% down, which, makes it more of a level playing field for sure.
Right. So many deals that I see, multifamily purchases in LA area, are value add properties where there's something wrong with the property. Maybe they all need to be updated, or maybe something structurally with the property has to be corrected or retrofitted, or something has to be done. And so it's not just buying a property that's up and running in rental, but it's really, you have to have a vision and you have to have the capital to buy and improve the property. What percentage of purchases are just buying it and they keep it in place and they meet your criteria, versus what percentage do you see? I don't know if you guys are going to do the construction side of that. If you don't, you're just seeing it as a refinance probably of somebody else's loan.
Well, we do both. I've had quite a few where borrowers are purchasing, let's say, a 5-unit, and they want to add 2 or 3 units, and that's kind of a semi-construction. Well, it is. It's an ADU, added units. But it's happening where borrowers are doing that right now. The people that have been purchasing the last couple of years, they definitely have more cash reserves to put down. They know they're putting 50, 60, 40 to 50% at least down, and they are putting money into renovating those units to bring them up to market. But again, it comes down to the guy that has the equity to pull out of other properties to put down, or has, cash to put down. It's been kind of an out of balance market for the for the smaller investors lately.
And of course, they all have an opportunity to partner with somebody who has more money, and that maybe is another solution for those people, is to go out and find somebody who has more equity and work together with them. Do you see that happening? Do you see partnerships and
a lot? Yeah, you kind of have to, just because of the amount down. But yeah, we do see a lot of that, and we do love lending to LLCs and corporations, and there is a lot of that going on, and there has been for years though. I mean, in the commercial market, it's not uncommon to see partners in that, where someone will manage the property and the other guy is more the equity animal.
Now, I'm sure every loan you do is perfect and they never go sideways or cause problems, but for the other loan officers at your bank who make mistakes, what are the common mistakes you see investors make where they get in over their heads, or they get in a situation that causes them to either lose a property or lose money on it? Maybe you have to sell it, at a loss, or sell it when they shouldn't have to. What do you see are the most common challenges or problems that investors face?
Are you asking about challenges from the investor perspective or the loan officer? Okay.
The investor.
I think, it's hard to say. It's challenges. I wouldn't say they're mistakes. I think we all grow and learn as we move forward, right? But a lot of times it is just biting off more than you can chew, or not taking the time to get educated. I know that there's a lot of, and I'm kind of answering twofold, because there's a lot of lenders out there who may not explain why we're looking at a certain amount down, what the debt coverage ratio is, and these guys just kind of get in and they don't realize how much improvement needs to be done to these units to get them up to market, or I'm working with a guy right now that is trying to refinance his property. He somewhat didn't pay attention to the property for the last 10 years. And the county, or actually it was the city that did a code enforcement out there. And we've got stairs that need to be repaired. We've got carports that are falling apart. There's a whole bunch of stuff. And because he somewhat hasn't paid attention to the property, now we've slowed down the refinance because we have to connect with the city to find exactly what that code enforcement is. He's frustrated because he wanted to use his equity to purchase something else. And now that equity has to be used to bring the property to, up to par, to make it safe for the tenants that live there. Right. So I think it really is like anything else. You just have to be as educated as you can and realize that, especially if you're buying an apartment, you're buying the home that people live in, and, keeping that up.
That guy you were just describing, I presume he had some positive cash flow during the course of the last 10 years, right? So, I mean, what have you been doing with all that extra cash? He wants to borrow money to go buy another place, and so he can do the same thing over and, wash, rinse, and repeat, right?
Right, exactly. And I don't know everybody's stories, but absolutely. I mean, that's something that you want to do is keep the units up, make it safe for people to live in, and who knows the reasoning there, but good point, Dave.
Well, sometimes it's just people get older and just don't pay attention. I know I work in the probate space. It's very common that properties are neglected 10, 20 years. Why? Because to take the energy to go out and look at the vendors and get quotes and write contracts, it gets harder as you go on in time. And if they're getting positive cash flow, they don't need to maximize the revenue. They don't need to maximize the long-term value in some cases. So that's the reason why I work in the probate space in particular is there's some turnover there, at least it happens regularly, but those properties tend to be pretty beat up usually when we get our hands on them.
Well, and Bill, that's a really, really good point. And one of those loopholes where, people will inherit properties and they've never owned an apartment before. Right. And grandma just passed away and left a 12 unit to all, 6 kids that happen to be in the trust, and nobody understands how to manage, navigate. And so those sort of do get put on the back burner until the kids kind of come up and figure out how to navigate it, right? The grown adults.
Right. And they walk in your office and say, oh, you lend up to 75% of the value. That sounds great. It's a $4 million property. Write me a check for $3 million. And you're, whoa.
Right.
Doesn't really work that way.
Okay, Bill, can I ask a question?
Go ahead, Nick Cates.
Yeah, hey, sorry, I'm driving, so that's why my camera's off. But what's the lending market for owners of multifamily who want to get capital to either develop their properties, add units, or improve the property in some way? What's the lending atmosphere like that? And for those owners who actually are able to add ADUs or other structures to their property, how does it affect the value from a underwriting standpoint? If they decide in the future to pull equity out or whatever, does it actually increase the value from a lender perspective?
That's a very, very good question. And you see it often where, like I said, a 5-unit property, they want to pull out some money. They've got the equity to add on 2 or 3 units. What we do and what a lot of investment lenders will do, we're going to look at today's rental income on the 4 units, but we're also going to do a market comprehensive survey, via the appraisal to find out what those units, the new units, might rent at. And most lenders will allow, just 65, maybe 70, but usually 65% total loan to cost, total future value, and take a look at it that way. So we sort of add in what market rents would be on the future units and use that to calculate what we're willing to give towards that. And then what lenders will do is do sort of a fund control, so we may do like a year construction loan to give them time, or in this market, even 18 months to give them time to build and add on those units. And then we would refinance at the end when all the units are rented up at market. Make sense?
Yeah, it does. My Bluetooth blew out, so I'm not sure if you can hear me, but
I can.
Yeah. So if there's an existing loan on the property, is it only the loan holder that the owner can go to try and pull money out? in order to have money for any new construction, or are there secondary lenders who are willing to lend against the property to do, development?
Well, yes to all of those questions. I mean, they certainly, it's, I want their business, but let's say they happen to be with Chase. It's fruitful to call Chase and see what they're offering, but I can take on a loan. I can do a refinance with takeout for construction, or we can do a construction loan depending. I mean, if a borrower owes $500,000 and they're looking for $50,000 to $100,000 to build a 6-unit, say it's 5-unit, then that might be more of a more of something where we give cash out and just hold back to, navigate that additional unit, the construction costs along the way. But if they're adding 2 or 3 units and we need more of a construction loan, more of a fund control type thing, but it doesn't matter which lender they go to. It really just comes down to, finding what works for that borrower's parameters. Does that make sense?
Yeah, so it's not like lenders are not doing loans at, relatively decent rates for owners of existing properties to develop or to, upgrade or anything like that.
It's case by case. It depends on the lender, but most lenders, it's going to be the same whether you stay with the same lender or you go somewhere else. It really is. I always tell investors, just make sure you shop around, get a really good broker, or call around yourself. That makes sense.
Right. Great. Thank you.
You're welcome.
The advantage of working with a professional always is the productivity of not making some of those major mistakes and getting a good plan together. So,
yep.
Great. So, Nick, I know that Melissa wants to send you some contact info. So, Melissa, I have that info if you need to get him.
Hey, Bill, it's Paul. I had a quick question for Gina.
Hey.
Hi, Gina.
Hi.
I had a question for you because I was looking at a deal in Chicago recently where I wanted to acquire a building that was 30% empty, and so I was making my offer when they mentioned to me that Amalgamated, it was like an agency paper type of loan. Amalgamated had actually approved a previous buyer that didn't close. They fell out of escrow. Amalgamated still wanted the deal, and to me, I thought I thought the terms and conditions were good. The only thing that I didn't quite understand was this: Amalgamated wanted me to have a net worth with my investment group of the exact amount of what the loan was going to be for, and I was like, sure, we can document that, I guess, a number of different ways, but the company that I formed is so new that the company on its own doesn't have that net worth. It's broken down by the individuals. And so when you do a larger loan like that, where maybe the company cannot show that it's, because this was like, I don't know, a $7 million, this was a $7 million ask. So how, in your experience, how would, for a newer investment company who's trying to make that acquisition, how do you do that in a way so that it doesn't set off red flags? Because obviously, if you have 3 partners, the ownership of those partners might look different, yet one partner might be lopsidedly, have much more assets, liquid assets, right, than a couple other partners. So how, does that get all figured out when it comes to the underwriting?
Well, and I guess my question to you, being that it was $7 million, was that a non-recourse or full recourse? Were they looking at the individuals as guarantors on this property, or were they just lending to the entity and not really underwriting the owners of the entity?
Yeah. So, that's a good question. So it was a non-recourse loan. So the 3 partners were going to have to sign as guarantors. So yes.
Okay.
But they weren't specific when I was asking some questions about qualifying for the asset requirement in order for them to originate that loan, how they wanted to see the asset qualification based upon our particular ownership, they were just like, well, we've got to go through it to figure it out. And I was like, well, I'll be happy to be upfront with you and just tell you right now exactly what the ownership is, and you can give me a quick yes or no, like, do you underwrite deals like this? So I'm just kind of curious, like, from your experience, because we were being totally transparent.
Sure. Well, and it's a great question. I obviously can't speak for that lender because I don't know all the moving parts on that particular deal. But Provident Bank, we most of the time, on a case by case, we're not, but for the most part, we're a full recourse lender, which means we are absolutely looking at the guarantors to kind of have skin in the game. We're not just lending to the entity itself. And we like it when our borrowers have an equal net worth to what the loan amount is.
Right.
And what we'll look at, we're not going to look at retirement because people aren't going to give up their retirement to save an investment property. So we're not looking at that. We're looking at liquidity in the bank and net worth in other properties. If you own a bunch of guitars that are worth $500,000, we're not going to look at that. We just, personal property doesn't count for the most part. We're looking at liquidity and real estate equity. Does that make sense? And we do.
Yeah, it does. What about if it was? Like multiple assets, like a large municipal bond portfolio, a large real estate portfolio, a large, stock portfolio. Like it was like a combination of all those things. Like especially a muni bond portfolio. I mean, kind of conservative. If there's a demonstration that a person's not a churn and burn, but a long-term hold investor, right? Argument could be that, well, this is someone that typically holds these bonds for, maturity and things like that.
Well, and you're absolutely correct. And again, it comes down case by case to each specific lender. We are a common sense lender, so we would consider anything that can be liquidated as net worth, right? Outside of retirement. But as I've heard throughout the years, not every lender is the same and not every lender looks at every asset similar. So, I unfortunately have to just kind of give you a broad answer on that because it really does depend on the lender.
Gotcha. In your experience with the loans that you've done, if you do see multiple partners and the partners are not equally weighted, is it okay to have one partner who may not have an equal weighting to be able to help qualify all of the other partners if the total package is large enough to meet the qualification for the loan itself, for the net worth loan?
Absolutely. In fact, what you're talking about happens more often than not in partnerships. Okay. It's not uncommon that I'll see, John Smith has 50% ownership, and then his brother's got 40%, and then we've got one guy with 10%, but he's got all the equity, he's got all the liquidity, he's got the better credit, and he wants to be a silent guy, but we'll pull him in as a guarantor because he has the weight, and John and his brother just kind of do the work to maintain and manage the property. It just depends. Everybody's got weight. And as long as the guy that's strongest, the behemoth that has the liquidity, has the assets, is willing to guarantee, we're comfortable with that. It's just we're going to, lean more on him, on his underwriting, the way he reports his taxes, all that good stuff.
Right. Gotcha. Okay. That sounds good. Thanks for answering that. I appreciate it.
You're welcome.
So I think we've covered the questions. I don't see anything else in the chat box. Gina, I really appreciate again the detail you've gone through, and I understand you can't speak for all lenders, but to understand your thought process has been really educational today. If somebody was interested and wanted to get in touch with you about lending, want to bring you business, particularly if they're a real estate broker, does loans like this and want to bring you business, how would they get in contact with you?
I am getting my contact information. I'll put it in and actually, if you open my rate sheet in the top left-hand corner is my contact information.
Okay.
But let me post everything up here. In fact, I'll even include a link with the password to the rate sheet. Where's I lost the chat box. Oh, no, I didn't. Okay, so here's my contact information, everyone. And I've been with Provident Bank. I'm not sure if I said that in the beginning. I've been there since 2008. No plans to go anywhere. Fantastic bank to work for. So not just today is my contact information valid, but should be for years to come till I can't lend anymore.
Well, and you started when you were 12 years old, so very impressive
yes.
career there at Provident Bank. So just real quick for those on the phone or watching, phone number on the rate sheet 951-403-0567. And her email is gkoenen, Koenen, at myprovident.com. gkoenen@myprovident.com. That'll be in the chat box, and description down below on our various social media if you're watching this on YouTube or Facebook or any of those. So anyhow, on behalf of everybody, Gina, I just want to thank you for participating with us today and being so helpful. And I think, as we said from the very beginning, educational, really giving people some good information to go on to hopefully build their own real estate wealth. On Wednesday, my colleague Annabelle Pacheco does a multifamily investing Zoom call like this for people when they get started. She, in fact, bought her first multifamily in Dallas, Texas. She walks through that process, and I believe in a year and a half or so, made over $1 million profit on a property that she bought and fixed up and then sold and put that money in the bank as investing somewhere else. So if you're interested in that, text or email me. I'll get the info for Annabelle Pacheco's multifamily. So look, again, Gina, thank you so much. Appreciate you being on. Thank you for those who participated. Nick and Dave and Paul and the others, Melissa, thank you for participating. We do this every Tuesday, 3 o'clock. It's realestateinvestingzoom.com. We can see it on YouTube. Go to Bill Gross EXP, and my YouTube channel is there, and you'll see past episodes. And we'd love to have you participate. Thank you all, everybody. Make today a great day, powerful week.